Welcome back to the Personal Finance Project. Today, Scott and I are going to do another Financial MythBusters segment. We are actually going to be reacting to another video on what creative director Kira calls FinTok, which is where a person on TikTok is giving unsolicited financial advice in an unregulated way. And we're going to provide our comments on this. So we're going to dive right in.
All right.
Here are the 5 different types of investments that I have as a financially responsible 33-year-old who plans on retiring early. Number 1 are my public REIT ETFs. A REIT is a real estate investment trust, and when you invest into a REIT, you become a part owner in a company that owns and operates real estate and then shares their profits with you. Now, a REIT ETF is just a collection of different REITs that allows me to become a part owner in a lot of companies with a single click. I love REITs because they allow you to get the benefits of being a landlord without actually being a landlord. And they are mandated to share 90% of their income with investors, so I really love these for passive income. Number 2, asset allocation.
All right. Well, I feel like in this particular video, because we've had the benefit of watching it, there's going to be a lot of instances where we are interacting with material, but it's kind of like trying to pin a jellyfish to the wall, where it won't necessarily be factually incorrect. Like, I don't think that this person is setting out to say things that are actually wrong. And I imagine the reason for that is she's probably done her research into this before she made the video. I don't know her that well, but I would venture that she's done at least that level of diligence.
I'll agree to that.
However, I think where you and I will have very strong disagreements with what she's saying is right out of the gate, talking about a 33-year-old, and I think she's based in Australia, so there might be some cultural and legal differences to kind of how these things work because we're based in the United States, but the premise is she's a 33-year-old with the goal of retiring early. And so she's talking about investing assets in a way that will produce income. And so far, when she's talking about public sector REITs, as I mentioned, there's nothing factually incorrect with what she's saying about how they directionally work, you know?
I would agree with you. The couple things that I would bring up just right off the bat is, one, so you're thinking about retiring early. When is the timeline for this? Because if the timeline is more than pretty much imminently, I'd pretty quickly argue that REITs are not the best place to be invested.
No.
And the reason for that is we're talking about growth versus income. And what has the ability to hit home runs instead of singles and doubles? It's going to be growth companies primarily based in the U.S., maybe small caps, some emerging markets, things like that. REITs, not historically known for massive, massive growth over time.
And I think that what you've said there is going to be the crux of the conversation, where we're not necessarily opposed in principle to these investment strategies. We're just opposed in principle, or we're just opposed to when a person should generally employ them and what that person will be hiring those investments, so to speak, to do within the confines of their portfolio.
Okay. The other thing that I was going to add is, and I don't know if you have a difference of opinion on this, we have another episode coming up that's kind of about this topic, is she mentions all the benefits of being a landlord without some of
without the difficulties. Yeah.
Okay. To me, the benefit, what are these benefits? I'm not really sure.
Yeah. I think what she's saying is you get the money, but you don't do the work. Yeah.
Okay, but you also don't get the appreciation of the house.
No, and you can't leverage your invest. I don't think she's suggesting that you lever yourself into REITs. That could be a disastrous idea. Whereas a lot of the reason people enjoy real estate or passive investments via real estate as a sensible strategy is because, particularly in the United States, and this might be different in Australia, you can put a lot of leverage on mortgages. I mean, you can be very levered, and that allows you to really extend yourself financially. And if done prudently, I think by owning maybe one home, perhaps a second home, you might not overextend to where you can find yourself in a disaster scenario. But if you're doing it like this, where you have leveraged yourself into a bunch of rental real estate, a common investment strategy, it can be extremely risky. And what will be absent, I'm sure, from this particular video is no discussion on the tax nature of these, passive income streams. And then also no real discussion of where this could really bite you.
Yep. I would agree to that.
Where do we go? There we are. I thought so.
People think investing in the stock market is hard to do because they don't know what stocks to pick. But picking the stocks is actually the easiest part. Instead of trying to look for the needle in the haystack and guess which company is going to do best, I just buy the entire haystack. I buy them all. And now it would be super expensive and super time consuming to go out and buy every single stock individually. So that's where asset allocation funds come in. They allow you to invest in thousands of companies representing the total stock market with a single click. Overall, the total stock market has gone up about 10% annually. Number 3 are my mortgage investment corporations, or MICs.
So I'm going to just stop there. Generally, what she just said, I don't have a huge issue with. I think when you are, say, 33 and trying to retire early, stock market index type funds are a great idea. The thing I'm going to say is that I don't think that the description is right. She's calling these asset allocation funds.
And again, that might be Canada cultural divide
okay.
on what they're referred to. But I was just going to add on to what you're saying is I think what she means by asset allocation is you're not selecting the individual components. You're just essentially allocating capital to a particular sector or a particular strategy.
I get that. And I guess my critique there might be if she's talking about the entire index or the NASDAQ or the S&P 500, sounds pretty good. But if along the lines of that first suggestion, which was REITs, if she's talking about energy and utilities because they pay out a bunch of income, I think that kind of defeats the purpose of what we're trying to do here.
Yeah.
Unless you're imminently retiring and live on your investment income at 34 years old.
Yeah, and it lacks specificity. So when you say something like an asset allocation fund, if you use that vernacular in the United States, we'd have a reaction very similar to this, where we'd say, what assets and how much are we allocating to them? I'm not sure what you mean by that. But I would venture, and this is just a guess, that she's talking about some kind of model, maybe an 80-20. And for the benefit of the listener, that means 80% stock, 20% bonds. And then maybe she's saying it's a total stock market index on the 80 and a total bond market index on the 20. We've talked at length about that kind of investment strategy. She, again, doesn't really say how much of your capital within those asset allocation funds should be aggressively invested versus, more fixed income oriented. And she doesn't mention whether or not she's talking about, like what you've said there, is this just another way to get more immediate income by owning just the parts of the market that have historically paid big dividends? Or is this really more geared towards something where you and I might have a conversation with a young person saying, yeah, if you want to own an S&P 500 index within your 401k, that's
great idea.
It's not a terrible idea. Yeah.
I'd be a lot worse ideas.
I was going to say, of the 5 bullet points so far, this one, somewhat sensible.
Yeah, I would agree.
These allow me to pool my money with other investors and then loan them out on mortgages. I make about 8 to 10% on my mix, and I really love these for passive income. Number 4, dividend ETFs.
Okay, so I don't know if you guys could hear that. She was talking about what are called MICs. And is there a proxy for those in the United States, or would this be like mortgage-backed securities?
I think mortgage-backed securities is where I would go with it.
Yeah. And I think what she's saying here is you're essentially buying a pool of mortgages and you're just benefiting from the cash flows. Now, incidentally, you and I just talked about this on one of our last podcasts, most recent podcasts. And one of the elements that we got into there was, particularly in the United States in 2025, interest rate volatility has been top of mind. And the weird part about mortgage backs, and I think this is something that people don't appreciate about them, is we talked about a little bit about how bonds reprice directionally with interest rate movements, but those things are really exacerbated with mortgage backs. And you can imagine that's because you don't benefit as much from an interest rate decline because people are going to refinance.
Yes.
So you're not going to collect those higher cash flows for longer. And then we talked about how the essentially average duration of a mortgage back, even a 30-year, is more like 7 to 10, and it's for that very purpose. However, you being one of the lucky ones, you locked in your mortgage at 2.5. They went up a bunch. And so the duration of your pool of mortgages actually extended considerably as a consequence.
Now, on the other side of that, you always do have, like, I could pay that mortgage off by virtue of selling by moving. Because as even, in a rising interest rate environment, we could have some impetus to move and then we pay it off early. So that's a little bit counterintuitive. But yes, generally, as rates go up, you're going to get extension from mortgage backs. As they go down, you're going to get those paid off quickly.
So essentially, your duration risk rises right when you would want it to be declining.
Yes.
And so that's again, I would imagine that most of the video will be absent more of an analysis on risk. But as part of a more considerate or well-constructed portfolio, if a sleeve of your fixed income holdings were mortgage-backed securities, having historically paid, 2 to 2.5% over government bonds, in sideways interest rate markets, they do pretty well.
Yeah, they do. The last thing that I would just add to this particular part is that I think I generally just question, what does this person do for a living? I think that's really important, because if they're making a lot of money, then I think all of these investments are kind of generating unnecessary taxable income.
Yeah.
I think for somebody in the U.S., say they're in a pretty high tax bracket, 32% above, if you wanted to have that kind of parking place dry powder, I'd lean municipals probably over taxable bonds. It's just personal preference, but I'd probably lean towards growth over income pretty across the board here.
Yeah, and I feel like even where interest rates are now, talking about on very high quality bonds, you can earn something like 4%. Let's just use that for easy math.
Yes.
I'm 33. If I took all of my liquid net worth, all of it, and put it into bonds that were somewhat safe and yielding 4%, I could not possibly live on or live the way that this woman is suggesting that people could live. And I don't know if it's because structurally in Canada or wherever this woman happens to be based, the vast majority of assets for young people aren't so tied up in their employer-provided plans.
Could be
Very specific to the United States. But that was one thing that right out of the gate we could have mentioned is structurally for a 33-year-old, a typical 33-year-old, I would venture that a disproportionate share of their wealth is, one, tied up in the present value of their future earnings, something that you were just getting at, and two, probably socked away in a place where they cannot readily access it.
Yeah, so that could be a U.S. versus Canada difference. But yeah, here, most of your money at 33 is going to probably be in a 401k.
And then I think for the benefit of the listener, these investments are not well suited for owning them within a 401k for a long period of time. It would make no sense to do that.
I would agree with you. And I guess what I was saying from the beginning was, outside of a 401k, I also don't think they make a ton of sense because of the income they're going to produce.
And you're going to get combed over, on the taxes for sure.
Companies that pay a high dividend, and a dividend is basically just where the company you own shares of shares their profits with you. I love these for passive income as well. I make about 5% in terms of passive income and dividends, plus appreciation where the value of the investment actually goes up over time. Number 5 are my...
So this was one, Scott, I know when we reviewed it, you had a real qualm with her very liberal use of the term passive income.
Yeah, and that could be the U.S.-Canada thing
Could be.
as well.
But I think that the point that you made when we discussed this previously was very good, because she was just talking there about dividend ETFs. And so generally what we would regard that to mean is these are 100% equity, so taking full brunt of the market risk. Maybe the beta or the standard deviation is slightly less than, say, something like the S&P 500. And it's essentially a collection of stocks that have a history of probably paying dividends, maybe increasing those dividends over time. And that's a really sensible way to invest if done within the confines of a portfolio. However, I think when we hear passive income, that means the corpus is never going to lose value. I don't have to worry about it at all. I would never need to touch it. And maybe that's the case for this person who's managed to retire at 33. But when we're counseling clients through that, we always lead with, guys, the price of these underlying securities, it will change. And it might change dramatically, because even value stocks struggled during COVID and they struggled during the great financial crisis. So I'm not particularly pleased with the vernacular either.
I'm not either. And my biggest issue probably is less the value could go down. It's more that when I hear passive income, I usually think tax shenanigans. So like basically you're trying to take depreciation on something that's paying you income and then somehow get a redeploy of that depreciation back at the end of the cycle somewhere, some kind of exchange in the future.
Yeah, like a 1031.
1031 in the future. I don't know. It just my thought is you're trying to get something for nothing if you're talking about passive income.
And I think one common strategy, and this is probably employed by people who do the rental real estate empire, so to speak, because you can take depreciation deductions on that real estate if it's employed in a legitimate business, and then you do get a tax deduction for that depreciation taken. Now, what you pay in the future is generally a much lower basis, but with the opportunity in the United States to do 1031 exchanges on real estate or investment property, you can essentially kick that can further and further down the road, and you probably add some cash to it over time. So if that's kind of that's generally, I think, what we would mean as passive income in the United States.
Yeah.
Is there's a real tax benefit associated, whereas a dividend ETF and a taxable account, if you're in the top marginal bracket, you might be paying out 24% tax on your income.
Yeah, and she may just be talking about what we would call investment income.
Yeah,
so
probably.
Now, these are similar to public REITs, but they are not sold on the stock exchange, so you have to use an exempt market dealer to buy them. They can be more risky than public REITs, however, the valuation doesn't fluctuate as much. And they typically pay out a higher dividend. I make about 8% dividend off of my private REITs, plus appreciation. Annually, over the last couple of years, the return has been like 16 to 18%, so these have done really well. And I'm adding in a bonus one, number 6, my GICs.
Okay, so immediate thoughts on this one was she, in basically the same sentence, said they might be more risky than public sector REITs, but the value doesn't move around as much.
Yeah, she did say that.
So generally investment risk, as we would regard it, two basic measures, your standard deviation, probably the most classic, or your beta, which is just a measure of volatility.
Yes.
And so in the United States, at least, volatility and risk, whether or not we agree on if that's the correct approximation, it doesn't really matter. That's how it's used. And so what I don't understand is how can an investment in a private REIT be more risky than a public REIT, but yet not move around in value as much? And
Basically,
I think you got the answer.
Yeah, I was going to say the answer to this question is that she likes it because it's like a house. It's not marked to the market. And so she gets an update on the value of these private REITs, maybe quarterly, maybe monthly. It just depends on what particular investments these things are in. So she likes it because she doesn't see it go down by 10% if the S&P 500 goes down by 10%. But what's really happening is the actual business case for it is pretty divorced from anything you can even track.
Yeah.
So I think what it's probably saying is that you're going to feel okay about it, even if it's crumbling, kind of behind the scenes and you have no idea what's happening in terms of the value of these assets.
Well, imagine people who had a mandate to provide investors with an update quarterly, and they provided an update at the end of March. And then Liberation Day happened, a couple of weeks later?
A couple of days later.
And so you got a value of your investment in March, and you were probably like, okay, it's been a sort of a rough year, but I'm feeling pretty good. And then you were totally, and I would say blissfully blind to the fact that these things got absolutely shellacked during Liberation Day, just like everything else. And then now you're going to get your next quarterly update when things have fully recovered, and you'd be like, man, dadgum, these private REITs. That's how you make your money.
The kind of crazy thing in this situation is that in that particular month, April of this year, we almost totally recovered by the end of April. So if you kind of just went to sleep from March 31st to April 30th, you may have had no idea that we had literally a 17, 18% correction in the course of a month.
And it would be the same with your primary real estate or your rental real estate.
Yeah.
You wouldn't have any clue that this was going on.
Yeah. And so the last critique that I have on this particular one, and I think this might even be bigger than the potential risk, because honestly, if you can get 16, 18% out of it because it's pretty risky, that's actually sounds pretty nice for a younger person.
Sure.
What I would say is liquidity.
Yeah.
You're 33, unless you already have tons and tons of money, in an emergency fund or all the real estate that the actual personal use real estate that you're going to need. Can you turn this into a down payment on a house, or if you have kids' school coming up that you need to pay for, or a medical thing that pops up? I value liquidity with my especially non-high growth investments.
Uh-huh.
If we're talking about somebody in their late 30s, I just don't think this is going to provide it.
No, and I think a lot of the times people get a question of, are you personally a stock or a bond? And so most people will regard their income, unless they're in some very, there are some one-off fields where you're probably more stock-like. But generally speaking, if you are in a stable job that's going to give you cost of living adjustments and also merit increases over time, your income is more bond-like. And so that's our primary concern with this video, is saying your human capital at age 33 should be the biggest component of all of your total capital. And so why would you then load up your financial capital in a way to resemble what you could already be doing for yourself? So you could be working on a specialization or a subspecialization to move yourself up in your career, earning more and more money. And that would insulate you, not entirely, but somewhat, from the vagaries of the market and allow you to capture those equity risk premiums or the spread between what you could earn in the stock market and what you could earn in, say, a treasury bill, or, plus or minus 2%, some of the investments that she's saying here, but you need to do it for a longer period of time. And I think at 33, the real risk would be taking way too many precautions with your money. As long as you've got your emergency fund in place, you're adequately insured, those things are table stakes. You got to do that. And I think that's a big part of the planning. But really taking too little risk with your money at age 33 is, weirdly enough, the biggest risk.
And especially too little risk in the wrong vehicle.
Right. She's giving us a bonus one. Here we go.
Number 6 here.
In the US, a similar investment would be a certificate of deposit. I use this if I have a lump sum of cash available for a short-term goal. I'm making about 5% off of mine right now. If you want to learn more about money and taking control of your financial future, I'm your girl. I've created 4 free money trainings for you to help you learn the things that you should have been taught in school. You can find them on our website under freebies. Hot girls don't gatekeep. So here are the 5 different types of investments.
Okay. I think that there's a good Kevin Kellyism, if I'm remembering correctly. It says a compliment with a request is not really a compliment. And so it's like this video with a request for her training courses at the end, it immediately calls into question the pretext of the video. So setting that aside,
I'm going to give her the benefit of the doubt.
Setting that aside, the liability matching or cash flow matching that she just talked about here with CDs being the kind of U.S. version of her government investment, government guarantee contract, something like that. Sensible. I think that's not the worst thing you could do with the money.
I agree with you, but in a period right now, money market fund, if you can pick a decent one versus CDs, maybe you lose 5 basis points of interest and you get 100% liquidity. I'd probably rather have the liquidity for that chunk of money, but to each their own.
Well, especially in the United States where you have strong protections, like you have FDIC protection on those deposits up to certain limits. Like obviously, I'm not saying you don't go wild here. There are limits to that, so it might not be the same wherever she's based, and maybe CDs or those contracts she's talking about might have more protection.
Yeah,
but in principle, if you have an outflow you need to make in 6 months, and you're like, well, I just want to put this money somewhere and not touch it for 6 months, you could do worse.
Yeah,
but I don't know. I feel like the whole point of this conversation, the crux was what you alluded to very early on in the conversation, is when should you be doing these things? And it's like if you really are on the fire train, then obviously your life is very different from the lives of the typical, I would say, median worker in the United States.
And just to clarify, financial independence, retire early.
That's what FIRE stands for, yes. So, and so you would have to have kind of an unusual lifestyle. Where if you could legitimately by 33 put enough money into these things that are right now yielding a lot, but I mean 5 years ago in the grand scheme of things was like 5 seconds ago.
Yeah, I was going to say I would be really interested if she was 33 in 2019, what she would have said.
Yeah.
Because 4 out of these 6 at least would be just non-starter ideas, I think, and because of super low interest rates.
Right, and because the interest rates were that low, if you think about trying to find yields that she's discussing here, you'd be going into like tax liens and all of these other crazy sort of like very speculative investments that just pick up current yield as opposed to just owning something a little bit more sensible and gathering those average returns for above average length of time. It's not as sexy as maybe retiring at 33, but I think it definitely works on average more often than this strategy might work.
So I think we're going to go with not necessarily busted here, but maybe not our recommendation in terms of the way not the way we would put it together.
No, and I think not the way most people are going to really live a wealthy lifestyle. I think.
Thank you for listening to another episode of the Personal Finance Project. This show would not exist without the help of our brilliant creative director, Kira Minifield. Kira, thank you for everything you do to keep this show running. On to the disclosures. This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. Robert W. Baird & Co. Incorporated is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. Investors should consider the investment objectives, risks, charges, and expenses of a fund carefully before investing. This and other information is found in the prospectus and summary prospectus. For a prospectus, please contact your financial professional and read it carefully before investing. Annuities carry unique risks, including market risk, investment risk, and claims-paying abilities of the insurer. There may also be instances where a contract will pay out less than the premiums paid or expire within the lifetime of the insured. There may be penalties for early withdrawal, and they are not insured by the FDIC because they are insurance, not an investment. Investors should consider carefully information contained in the prospectus or, if available, the summary prospectus, including investment objectives, risks, charges, and expenses. You can request a prospectus by reaching out to your financial advisor. Please read the prospectus carefully before investing. Investment returns will fluctuate and are subject to market volatility, so that an investor's shares, when redeemed or sold, may be worth more or less than their original cost. Unlike mutual funds, shares of ETFs are not individually redeemable directly with the ETF. Shares of ETFs are bought and sold at market price, which may be higher or lower than the net asset value, NAV. Baird does not issue or underwrite mortgages and does not service mortgage lending services. Any references to mortgages in the financial services offerings are purely intended to convey an engagement in this holistic planning process, with this as one piece of the larger picture, which may or may not apply to all clients. This broadcast may not be reproduced without express permission of Robert W. Baird & Co. Incorporated.